What's up everyone, it's Kadi with MoneyVest. So in today's video, we are going to be talking about a very interesting research report from Glenmead Research Analysis or Glenmead Investment Management, where they talk about how forecasting from the Federal Reserve when it comes to interest rates is about as inaccurate as it could be after a certain time period. So we're going to talk all about it. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. I would really appreciate that. And links to our Discord and Patreon is going to be down below if you're interested in joining. I did open up a few more spots with that 16% annual discount. You get access to all my buy and sell alerts, options alerts, trade ideas, intrinsic value spreadsheets, fair values for individual stocks, including a lot of private videos and stock analysis and tutorials and lectures. I recently posted a video going over why I'm investing heavily in this one particular market and why I'm buying more in this area. So definitely do check that out. Link's going to be down below. You get a lot of ad-free content and of course access to a lot of alerts as well. And of course do check out the courses. So lifetime access to a lot of courses, fundamental analysis, technicals, options, and psychology. And of course you get over 120, 130 plus lectures with over 30 hours of content. And do connect with me on Instagram. My handle is going to be CAS@WRP. We'd love to have you on board over there as well. I do post a lot of profit and loss, my portfolio updates and stuff like that if you are interested in that as well. So link's going to be down below for that. So this right here is an analysis from Glenmead Investment Management, right? So the purpose of this analysis is to really basically understand how to look at the Federal Reserve's summary of economic projections and the dot plot, right? The dot plot, as we already know, is what the Federal Reserve members, the FOMC members, are expecting for rates to be in the longer run, right? So they've got a projection for 2024, 2025, 2026, and then longer run as well. Now, what they have done is that they have gone back to 2012, right? So 2012 all the way through 2023. So they've basically gone back 11 years and they figured out, they basically learned that the dot plot is more often wrong after a 6-month period than it is correct with those expectations. So really what they're saying is that post 6 months, the Federal Reserve's expectation of interest rates is about irrelevant and useless as it gets, because even they don't know what interest rates are going to look like after a 6-month period. So the Fed's dot plot is again causing a stir as investors try to glean wisdom about the longer term trajectory of interest rates. And as we know from yesterday's summary of economic projections, the Federal Reserve pretty much told us that they are going to be cutting rates 3 times. So 3 rate cuts are going to be priced in for the market for 2024. And some prominent publications are even suggesting that the change in the longer term rate forecast indicates a higher forever regime. But before we opine on the potential ramifications, it would be prudent to ask whether the Fed's projections are historically predictive, right? That's what we're trying to answer with this analysis of Fed's projections. Are they even historically predictive? And based on the September reports of the dot plot since 2012, the Fed's short-term projections, so very, very important to highlight here, is the short-term projections through year end, roughly a 3.5 month window. So basically 3 to 6 month window were spot on with a correlation of 0.996. So meaning 3 to 6 month window for the projections in their summary of economic projections tends to be spot on with a very, very high correlation of what the rates are going to look like in the next 3 to 6 months. And when we look at the picture changes, when we look at the longer term, post 6 months, the picture changes drastically. When one looks beyond that window, projections for the following year, roughly 15 and a half months out, which is a little bit over a year out, and have had a much lower correlation of 0.61. While this is better than using the current Fed funds rate level at the time of prediction of 0.42 correlation, it was worse than using the Fed's prediction for the current year, 0.62. In other words, history suggests one would arguably have been better off using 2023's rate projections and throwing out any information for 2024. And furthermore, the Fed's projections for 2 years out reflect whipsaws as astoundingly negative correlation, meaning that they do the exact opposite of what they have penciled in their summary of economic projections 2 years out versus the actual Fed funds rate with an average error of more than 2% as well. So that basically is a very interesting study and just goes to show that nobody, at the end of the day, nobody in the world can really know where rates are going to be after 6 months, let alone a year, 2 years, 3 years, 5 years from now. We have very little information with respect to where rates are going to be. So there's a lot of uncertainty about fluctuations. And that's why I've mentioned before in my previous videos, what did we talk about? What is the one thing the market doesn't like? The market does not like any type of uncertainty, right? That's one word the market just absolutely hates, and that is uncertainty. Which has more uncertainty, quantitative tightening or quantitative easing? Pause this video and answer this simple question. What carries more uncertainty, quantitative tightening or quantitative easing? When it comes to quantitative easing, there is less uncertainty because the Federal Reserve is trying to fix something. And if there's a recession, if there's a crisis, if there's unemployment going higher, if there's inflation that's really low, what does the Federal Reserve do? They want to stimulate the economy. They want to lower interest rates. They want to do them as quickly as possible. And what is the lowest level that we can possibly get down to when it comes to quantitative easing? 0%. We can't go any lower, right? We can literally, that's the floor. Once we get down to 0%, done. We're done with quantitative easing, and the market knows that. But on the way up, there is there's no guarantees to how high we could possibly go. There is a lot of uncertainty baked on quantitative tightening because nobody has any idea how high are we going to go. And once we get up there, once again, nobody has any idea how long are we going to stay up there and how quickly are we going to see potential rate cuts in the future. So that all that uncertainty gets baked into the pricing, and of course that's exactly why we saw the bear market in 2022. And this right here is from Michael Reynolds, Vice President of Investment Strategy at Glenmead, who basically came up with that analysis. And he says that we still think there's a bit of gulf between the amount of cuts expected by the markets and what the Fed is telling us. The Fed is getting us prepared for a Goldilocks scenario in which nothing else gets in the way, but history shows that things tend to pop up and disrupt things along the way as well, because that's really true. The Federal Reserve's penciling in, look, nothing's going to happen. Everything's going to be fine. It's going to be a smooth sailing to soft landing, which Janet Yellen also mentioned. I've got a video coming out for later or today for that as well, because Janet Yellen also says there is going to be a soft landing. But history does show us that when rates are higher for longer, there is an element of risk with respect to something breaking, something happening, a crisis, something that really pops, and that causes the Federal Reserve to completely change their overall forecast for interest rates. And he also cited a variety of unknowns over the past 2 years, such as the supply chain disruptions that followed the U.S. onset with the COVID-19 pandemic, Russia's invasion of Ukraine, and the biggest outstanding risk that remains now is what happens to oil prices, which could set investors up for a nasty surprise if they suddenly start going higher. Time will tell the appropriate level of interest rates really is, but the market and the Fed may be getting ahead of themselves, is what he says. Nobody's a perfect predictor or arbiter of where interest rates will go. And the conclusion here is that there could be less than 3 rate cuts in 2024 or more than that, and people tend to take the Fed at its word, but there's too much uncertainty to predict that with any certainty as well. And this right here, of course, is today as traders brace for a chaotic triple witching Friday as $5 trillion in expiring options collide with index rebalancing mania as well. So we've got a very, very important day on our hands. So pretty much today, when the markets close in a few hours, there's going to be over $5 trillion worth of options, stock options, ETF and index options and futures that are set to expire on Friday. This is the 3rd Friday of the month, which is also triple witching. Expiration that events collides with the rebalancing of the S&P and the NASDAQ 100 as well. So these right here are all the options, ETF options, index options with the notional value that are set to expire as well. And 8% of S&P market cap next week expiration is the largest S&P total in more than a decade. So the amount of expirations that we have set for today is going to be the largest in over 10 years since 2012 as a percentage of S&P 500's market cap. So this, again, is going to create a lot of volatility in the day. And of course, the T-vol index, the total volume on the New York Stock Exchange, also is going to spike to incredible levels. So definitely got to be careful for the rest of the day for the volatility. Of course, that could be very, very high at the moment. And speaking of volatility, we're still seeing it very, very subdued, down a little bit over 2% to just over 12.2 levels. And of course, we're trading inside this red rectangle, which definitely has me on alert and I'm definitely cautiously optimistic on this market considering how low we are on the VIX and how incredibly overextended and overbought we are on the market. So not saying that the market's going to start selling off right away. Nope, markets can remain overbought for longer, but it's just something that we have to be prepared for, and something from a risk reward standpoint I'm constantly going to be aware and assessing in the markets moving forward. So hope you all enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to connect with me on Instagram. Definitely do check that out. Link's going to be down below for our courses, for Patreon, for Discord, for trade alerts, ideas, buy and sell alerts, intrinsic value, fair values, members only private videos. Everything is going to be included with the link down below. And as always, happy investing. I'll see you all in the next video.